Southeast Radio's Business Matters with Karl Fitzpatrick.
Well, banking analyst John Cronin from SeaPoint Insights returns to Business Matters this morning to explain why Irish banks have been posting such high returns. John, historically Irish banks had a reputation for recording lacklustre profits. So what has changed?
Morning, Karl. A few things. Firstly, and most importantly, the higher official rate backdrop. So what I mean by that is the level of increase we've seen in European Central Bank official interest rates. The reason why that's constructive for bank profitability boils down to one point in the main, and that is, spreads widen. So the spread between loan yields and deposit costs widens typically as official rates go up. That's a phenomenon we've seen, observed through various cycles in various jurisdictions over the years. However, in the case of Ireland, one also needs to think about how competition has evolved in the market with, the more recent exits being Ulster Bank and KBC. So a very small market in terms of local deposit takers. What we do observe in Ireland is that the customer is very inert. So even within the same institutions, there's a potential to, extract a much higher overall rate if you are a depositor, but essentially people don't take advantage of that. So the Irish banks have a disproportionate share of domestic deposits sitting in current accounts. That has been, the key reason for why we have seen, such a turnaround in terms of the returns earned by the banks.
And of course, we've read a lot over the course of the past decade about banks selling non-performing loans. Has this helped, John?
It has, yes. I mean, it's helped from a few different perspectives. One is, while the yield on the non-performing loans, some of them are repaying and some parts can be quite healthy, especially when, a bank moves to enforce. The regulator penalises banks heavily in terms of higher capital requirements on those loans. So they have, and the more capital you need to hold, the less your returns are. So divesting of those non-performing loans has been a key plank as well in terms of the Irish bank return story. If I take PTSB, they did an enormous job under the current and the previous chief executive to move their non-performing loan ratio down from 30% to low single digits now. And it's also improved in terms of investor sentiment. Investor sentiment towards banks, and we've seen it with Italian and Greek banks and Spanish banks as well. It sours when you see a large share of non-performing loans on their balance sheets. And that is kind of interrelated with the point where the regulator penalises banks for them.
And how have rising interest rates contributed to the sector's profitability in recent years?
The level of pass-through on the deposit side, if you actually look at the overall pool of deposits and the average rate paid on those, the level of pass-through has been very, very contained and runs at a much lower rate than we see in other markets. And so what that's done is, it's contributed massively to the returns delivery on the part of the sector. But actually, it's also allowed the banks, in their core, in the mortgages domain, which is their largest product effectively from a lending standpoint, it has allowed them not pass on the full extent of the rate increases to the customer. In fact, we've seen pass-through run at just around the 50% mark. That's been very helpful from an Irish loan mortgage holder perspective. So, you haven't got this dynamic where every other day you look at the newspapers in the UK and you've got headlines around the refinancing horrors that households face there, where the Irish banks didn't push up rates to the same extent. So that's good for the customer. Well, it's good for the mortgage customer. It's good for the loan quality. So it reduces the risk of loan losses to the extent that they're not pushing rates up substantially on mortgage products. And yet they still are churning out enormous returns, with AIB posting 25.5% return on tangible equity at the half year, for example, the leader of the pack there.
But it has been well reported on, John, that Ireland, we had some of the highest mortgage rates in Europe.
That is right, and we did. We were, generally speaking, second in the charts amongst all European countries prior to official rates beginning to climb. We're now mid-pack. We've moved up a tiny bit recently, but we're generally middle of the pack now. And that is back to the point that the banks did not pass through the full extent of rate increases to the mortgage customer. Now, with that said, as rates reduce, as official rates reduce, I don't think you're going to see the rates, just like the banks didn't pass through all of the rate increases on the way up. I suspect they're not going to pass them all through on the way down. And the reason I think that is, there's going to be some natural erosion of the benefit that they're getting from low-cost deposits, because they can't push deposit pricing down much further as interest rates reduce. So they're going to look to make up some of the, clearly to the extent they were to pass through the full extent of rate increases on the way down, it would really compress their margins and their returns. So I think they look to get something back to that channel. But I don't think we're going back up to the top of the chart in terms of mortgage pricing anytime soon.
And John, why are deposit rates so low here in the Irish market when surely consumers can seek out better returns elsewhere?
I think there are a few things that go to explain why the customer doesn't move. One, I suspect that there is just this fear factor around needing overnight access to money, although it doesn't fully explain it, because the overnight access products, as opposed to the current accounts, do yield a better rate. So you would expect to see a bit more shift into those. Now, the rate difference, but that is the key point. Like the Irish banks have talked about upping their rates a lot, but it's really only on the term products. The instant access products, you can get a little bit of a return out of them, but it's very low. It's the term products is where you need to be, and actually that's predominantly 1 year and 2 year term. Although AIB did launch a 31-day notice account for business customers, I think it's just apathy. People don't bother making the changes. It takes time. It's a bit of effort from an administrative perspective. It's deposit interest retention tax, which is 33%. So, like, if you're sitting on 100,000 in AIB, that's earning, you might be earning a zero interest rate, but if you want to keep it in one of the Irish banks, you might be able to get 1.5 to 2%. So you save €1,500 to €2,000 a year, a lot of money. But then you take out the deposit interest retention tax, and it significantly suppresses that. And the reality here is, the average deposit balance is only a little over 12,000. So if you actually apply the numbers to that, how much are people really going to save? And I think they're the reasons why people don't move.
We're in the midst of a rate reduction cycle that's probably going to go on 2 or 3 years from now, and also the fact there are new entrants in the market. What are your predictions in terms of banks' profitability over the coming years?
I think it's inevitable that we will see some compression in the very high returns enjoyed by the banks today. And look, all the management teams have guided that we're going through an extraordinary period, I think, to use the language of one banker in particular. And look, I think that guidance is valid in terms of the kind of general direction of travel. What I would say is, if you look at some of the banks, without getting into the weeds on this, the target returns on equity are, so if I take AIB, it's 15% for 2026. They're in the mid-20s today. I think, look, a lot needs to happen for returns to fall back to that level. I think, the market is likely, despite the fact that we have new entrants, I still think the market structure isn't going to change enormously over the next 2 to 3 years. I think, yes, some incremental level of competition, but not a sea shift. Interest rates will fall back, and that will naturally bring returns down a little bit. But actually, there are ways in which the banks can help themselves in that respect as well, where they don't pass on all of the rate reductions to loan customers, and there are lag effects as well. And outside of that, they will have to continue to invest heavily in digital and in their systems more broadly. But I'm not seeing any great risks. There are pockets of the commercial real estate market, particularly in office, where you could see potential loan losses mount. But actually, if you look at provisioning for future losses across the sector, it's very, very strong relative to other European banks. So they have a lot of cushion to cope with problems. So I don't see any, I see returns coming down, but I think, still remaining at very healthy levels right into the medium term.
Well, if you've just tuned in, that was John Cronin from SeaPoint Insights, and I would like to thank John for sharing his knowledge of the Irish banking industry with us over the past few months.
Southeast Radio's Business Matters with Karl Fitzpatrick.